Institutional accumulation in TWLO just hit 33 times the daily average, signaling a structural floor that the mainstream retail narrative is completely ignoring. While the fear index sits at 39, the smart money is aggressively absorbing. By XNDU. Lab scores 61. Xanadu's cloud quantum platform slashes client capex by $2.8 million per deployment. No need to buy $3 million cryogenic systems. Wall Street sees hardware plays, but the lab sees software margin leverage. 84% gross margin on QPaaS subscriptions. The data teardown reveals a stealth infrastructure as a service play wrapped in Quantum's halo. Xanadu's hardware moat is secured by its 8-mode photonic architecture, which eliminates the cryogenic cooling requirements that cripple superconducting competitors. While IBM struggles with the thermal noise and massive cooling footprints of its 433-qubit Osprey processor, Xanadu's X8 chip operates at room temperature by utilizing squeezed light. The lab tracks the physical constraint here as the classical quantum interface latency, the delay when moving data between standard. Xanadu's 163.7% revenue surge is the ultimate geopolitical hedge against a hawkish Fed and escalating global trade wars. While the Fed holds rates steady at 3.64%, the yield spread, the difference between long-term and short-term interest rates, has normalized to plus 0.52%. This normalization usually signals a tightening environment where speculative growth dies. Yet, Xanadu is thriving because it has bypassed the private capital squeeze. By running PennyLane, an open-source software framework for quantum machine learning, on the Frontier supercomputer, Xanadu has secured a structural alliance with the Department of Energy. This is not just a partnership, it is a defensive pivot. While CPI, the Consumer Price Index measuring inflation, sits at a low 0.6%. The real macro friction is the hawkish pause, signaled by the federal Xanadu's 163.7% growth proves that government-backed engineering remains insulated from these monetary headwinds. The lab views this 24.1% price surge as a flight to safety amid escalating tariff uncertainty. As global trade faces renewed threats from trade war rhetoric, hardware-dependent firms are scrambling. Xanadu's software-led integration with the ORNL, Oak Ridge National Laboratory, provides a unique immunity to physical supply chain choke points. While the market stumbles over geopolitical instability and a hawkish Fed, Xanadu is scaling via deep moat government contracts. This is the fortress balance sheet play in action. We are seeing a rotation out of vulnerable consumer tech and into sovereign-aligned compute. Even as Minneapolis Fed President Neel Kashkari claims the economy is too uncertain to signal rate cuts, Xanadu's revenue trajectory remains decoupled from traditional cycles. The verdict is clear. Xanadu has successfully positioned itself as a critical node in the national defense architecture. It is the only hedge that matters in a high-tariff, high-friction world. Segment 3. The PR Insider Filter. Xanadu Quantum Technologies Limited Part A. Xanadu just dropped a press release. Xanadu Quantum and DOE's ORNL collaborate to run PennyLane on Frontier supercomputer for Q. Translation: we're on a government-funded playground with the world's fastest supercomputer. Management wants you to hear strategic partnership and quantum advantage. What they're not saying: this is a lifeline. Without DOE access, Xanadu's photonic qubits would be running on simulators in a closet. No insider selling in 90 days. Fine, but institutions are quietly loading up, holding 17.5% across just 4 funds. That's not conviction. That's a concentrated bet on a single narrative. When 4 funds own nearly a fifth of your float, they're not diversifying, they're cornering a story. Part B R&D spend hit $55 million, 1,196% of revenue, up 40.8% YOY. That's not efficiency, that's desperation. You don't burn 12 times your revenue on R&D unless your product isn't selling. Management calls it pipeline investment. The lab hears we're years from commercialization. Meanwhile, the 10Q risk factors would read: our technology may never achieve fault tolerance, and our sole revenue stream, government grants, is subject to political whims. They're papering over a hardware problem with a PR win. What management is saying, we're leading quantum software. What the lab hears, we're one canceled grant away from a cash crunch. Xanadu's core strength lies in its cloud access model, a scalable platform that sidesteps the massive capital expenditure of on-premise hardware for clients. We see a bullish flag pattern, a technical setup where a sharp price spike is followed by a brief downward consolidation, indicating a potential leg up. This architectural move toward cloud-based quantum services allows XNDU to compete directly with giants like IBM. However, engineering reality is hitting the supply chain. New tariffs on specialized lasers, the photon sources required for Xanadu's specific quantum architecture, threaten to crush gross margins before they even turn positive. With volume dropping 37.4% below the 20-day average and an RSI of 69.7, Relative Strength Index, a momentum oscillator that signals overbought conditions when it nears 70, the stock is gasping for air at the top of its range. The question we're asking in the lab is this: can a partnership with big tech actually offset the physical bottleneck of specialized laser procurement? The answer is no. While management pivots to partnership language to distract from the 68.2x forward P/E, price-to-earnings ratio, a valuation metric comparing share price to projected earnings, the hardware reality is that you cannot scale cloud-based quantum without the physical emitters. If the supply chain for those lasers stalls, no amount of software partnerships will fix the lack of compute cycles. The lab's verdict is clear. With an AI score of 61 out of 100, we are not buyers at this level. Watch the $36.12 resistance, the price ceiling where selling pressure historically outweighs buying. If XNDU fails to break $36.12 on high volume, expect a retracement toward the MA200, the 200-day moving average, at $18.18. TWLO earns a 71 out of 100 buy. Institutional conviction just hit a 33-day volume high. But the real story is margin physics. TWLO's gross margin expanded 270 BPS sequentially to 55.3% in Q1, proving the AI-driven contact center mix shift is finally outpacing legacy SMS dilution. Wall Street still treats this as a SaaS story. The lab sees a hardware-adjacent cash flow engine. The data teardown reveals TWLO's 350% income surge is a direct result of optimizing its API orchestration layer, the software logic that routes messages, reducing latency, the time it takes for a server to respond to a request, below 150 milliseconds while slashing compute overhead. While Wall Street focuses, TWLO has evolved into a 350% income growth engine that thrives as the Fed's hawkish pause. The decision to keep interest rates high to combat persistent inflation crushes weaker software competitors. The 10-year yield at 4.4% and a normalizing yield spread, the difference between long-term and short-term interest rates, signal that capital is no longer free. The lab sees TWLO's 375% EPS, earnings per share, the portion of a company's profit allocated to each outstanding share, growth as the ultimate defensive signal. With unemployment at 4.3%, TWLO's automated communication scale without the rising labor costs hitting service-heavy firms. Prediction markets show only a 16% chance of a rate cut by late 2. Segment 3. The PR Insider Filter. TWLO Incorporated, TWLO. TWLO's press release opens with a headline: AI-driven demand fuels record 350% income growth. Management is selling a story of unstoppable momentum, AI adoption, enterprise expansion, and margin leverage. But let's flip the table. Insiders net sold 49,588 shares in the past 90 days. That's not a trickle, that's a fire hose. When executives dump nearly 50,000 shares while the stock hits a 4-year high, it's not confidence, it's a liquidity exit. Historically, this pattern precedes a narrative shift. Growth slows, margins compress, and the AI tailwind becomes a headwind of customer churn. The EPS beat, $1.50 versus $1.30. Looks like a win, but dig deeper. R&D spend grew just 1.1% YOY, now at 20.1% of revenue. That's not acceleration, that's a deceleration. When R&D growth lags revenue, it signals a pipeline running dry. Meanwhile, institutional holders, 94.1% of the float, are quietly selling. The top 5 funds reduced positions last quarter. Management's PR glosses over this with vague shareholder returns language, but the 10Q would flag it. Reliance on AI-driven growth without corresponding R&D investment increases risk of product obsolescence. What management is saying, we're leading the AI revolution. What the lab hears, we're milking the last cycle before the music stops. Institutional conviction is surging with trading volume 33.6% above the 20-day average, signaling that big money is betting on Twilio's flexible API, the application programming interface that allows different software programs to communicate as a structural moat. By dominating the cloud communication shift, Twilio is scaling like a software utility while leveraging lower borrowing costs from recent Fed cuts to aggressively fund its research and development. Physical reality is biting back through supply chain friction. Twilio faces direct margin pressure from escalating tariffs on hardware imported from China, increasing the cost of the physical infrastructure powering its cloud. Meanwhile, the stock is screaming overbought with an RSI, Relative Strength Index, a momentum indicator measuring the speed of price changes, of 85.3. We are currently tracking a rising wedge, a bearish chart pattern where price narrows upward between two converging trend lines, signaling a potential momentum exhaustion. Here is the question the C-suite dreads. How does Twilio justify a trailing PE, the ratio of current share price to its per-share earnings over the past year, of 277.8x, while Amazon increases competitive pressure? The lab's answer is that the forward PE of 28.0x assumes a flawless transition from growth at any cost to high margin efficiency. Management is banking on a captive AI customer base to absorb the pass-through costs of hardware tariffs. If those customers churn, that 28x multiple is a fantasy. With an AI score of 71 out of 100, the lab's verdict is clear. Do not chase this move into the $183.34 resistance level. Wait for a mean reversion toward the $117.65 support level before deploying fresh capital. The engineering is sound, but the current price is a technical trap. Twilio's 7nm AI inference die just flipped the script. This is the signal Wall Street missed. Hit subscribe, smash like, and drop a comment. Should we tear into XNDU's 3D packaging yields or Twilio's hyperscale capex next? Your call. Remember, this is engineering-level education, not financial advice. Markets move fast, margins shift overnight, and past performance never guarantees future returns. Always run your own numbers before pulling the trigger. The lab's out. See you in the next breakdown.